Hello everyone, welcome you all in this session of PT Dictionary, and today we'll continue uh, from yesterday's class onwards. Yesterday we discussed the money supply, and we also discussed the types of inflation. We also discussed how RBI also functions and all. So today we'll discuss the first topic, that is your factors affecting money supply. Factors affecting money supply. Uh, we'll see. Yesterday we discussed that money multiplier and all, but we must know how this money supply in the economy is determined, because sometimes UPSC asks a statement based question. So we'll definitely talk about that. So what is this? I think money supply you have already we have already discussed, and you have read as well. So what are the factors which affects this money supply? The first factor, that is money multiplier, obviously. And yesterday also we have seen how this money multiplier affects, or how this money multiplier is affected by the cash reserve ratio. Yesterday we have discussed. So how this money multiplier affects the money supply? When money multiplier rises or increases, you can say, then money supply in the economy also increases. This is the fundamental feature or relationship between the money supply and money multiplier. Again, you can ask, sir, what is the basis of which this money multiplier rises or increases? I would introduce before you one concept, that is velocity of money. When the velocity of money increases, then money multiplier also increases. Then you may ask, sir, what is this velocity of money? Velocity of money means, simply I am giving you one example. If 500 rupees or 500 denomination of rupees, how this 500 denomination of rupees changes in hand in a particular period of time, or how many hands that 500 rupees changes in a particular period of time or over a period of time, or how many people this 500 rupees has been used by these consumers in a particular period of time. That is known as your velocity of money. So when this particular denomination or 500 rupees denomination changes hands to another, that means money is circulating in a faster way, or that you can say increase in the money multiplier, which results into increase in the money supply. So whenever there would be a statement like this, increase in money multiplier leads to increase in money supply, yes, this statement is correct. If any such question will come, increase in velocity of money, increase in the money supply, yes, again this statement is correct, because the money changing its hand from one to another. So in that manner, this money circulation in the economy is also increasing, or money supply in the economy also increasing. This is the first important point, how money supply increases in the economy due to the money multiplier. Coming to the second reason behind it, why this money supply increases: banking penetration, or you can say increase in banking habits of the people. Increase in the banking habits of the people. through which this money supply in the economy also increases. Clear? This is second reason or determinant behind the increase in money supply. Coming to the third, what is the third reason behind the increase in money supply? Suppose government borrows money from RBI against government securities. I am repeating this. Suppose government borrowing from RBI using this government securities, then that money which is coming to the government will definitely use that money for welfare purpose or will inject money into the economy. For example, October, November 2020, when this pandemic was, or you can say the first lockdown was going on, and there was an economic disruption in the economy due to this pandemic, then government came with this, what? Atmanirbhar Bharat. Atmanirbhar Bharat. So government injected money into different sectors. So in a way, if government, by borrowing from the RBI or Reserve Bank of India, by using these government securities, if injected money into the economy, that also leads to increase in the money supply, or you can say due to the government borrowing. Okay? Government borrowing also increases money supply in the economy. Coming to the next, what are other reasons behind it? The second is, suppose RBI adopts cheaper or cheap monetary policy. We'll discuss about monetary policy after a few minutes, but what is this exactly this point wants to convey? This point wants to convey cheap monetary policy, again also known as expansionary monetary policy. What is this expansionary monetary policy? Suppose RBI reduces all those monetary controlling tools. Okay, so due to that, commercial banks have more funds to involve in the lending activities. So more funds will go to the economy. So money supply would increase in the economy. So expansionary monetary policy is one such factor behind the determinants of monetary policy. So you can expect statement based question, which of the following factors affect the monetary policy in the economy? The first, you have to understand this money multiplier. If money multiplier increases, then it leads to increase in the money supply in the economy. Then what is this money multiplier? Money multiplier means increase in the monetary base that affects the increase in the money supply. And again, what is this monetary base? The money with the public and the bank. Now coming to this velocity of money, I mean how much a money or a denomination of money circulates in the economy with the changing of hands. That means how much people or how many people are using that a particular unit of money, that is known as your velocity of circulation of money. With that, money supply also increases in the economy. This is the first concept. Second concept, banking penetration. What is this financial inclusion? You must have heard about it. Financial inclusion means our job is to bring every person into the banking network. So the banking, with the increase in the banking habits, so money supply also increases in the economy. So this is the second point. Third is the government borrowing that I have already discussed, that if government is borrowing money from the RBI by using this government securities, that also increases the money supply in the economy. Coming to the fourth, adoption of cheap monetary policy, or you can say the expansionary monetary policy by using those different tools by the Reserve Bank of India, that also increases monetary policy, money supply in the economy. Now, coming to the next aspect, Yesterday we have already discussed this inflation. Now today we'll see, or along with the inflation, we have already discussed those types like hyperinflation, creeping inflation, galloping inflation, etc. Now let's discuss the types of inflation on the basis of causes. What is this, or what are those different types of inflation on the basis of causes? One is your demand pull, another one is your cost push. Now what is this demand pull? Demand pull means simply you can say that supply remaining constant if demand rises more than the supply in the economy. I repeat, what is this demand pull? Simply you can understand, or you can remember, if demand exceeds supply, then that is known as your demand pull. Example, what is this demand pull in inflation? Example, suppose income of the people increased due to let's say revise the payment or due to the pay commission. Income of the people increased, or you can say suppose government revised this minimum wage rate, then income of the population or the people increased. So due to that, your purchasing capacity or your purchasing power also increases with the increase in the income. So when purchasing power of people increases with the increase in income, they will definitely demand more goods and services. So when they demand more goods and services, but supply of that goods and services remaining constant, so demand greater than the supply, that leads to demand pull inflation. This is one such example I have given to you. Second case you can see, suppose I'm giving you that Atmanirbhar Bharat example. Suppose government injecting money into the economy due to balance the economy. Suppose in the pandemic kind of situation, when all the economic systems were disrupted, so government wants to revive the economy with the injection of money into the economy. What government did? Injected money into the economy. But at the same rate, you cannot increase your goods and services or production of goods and services. So, your demand has been increased, but the supply remaining constant, or supply could not increase at the rate of increase in the demand. So that leads to demand pull inflation. Clear? This is the first such type. Second is cost push inflation. I am giving you one example. Suppose an industry producing, let's say, steel. So the price of electricity increased. This is one. Suppose price of raw material also increased. Price of electricity increased, price of raw material also increased. So what will happen? Definitely the price of steel produced by that industry will also increase. I repeat, electricity, the price of electricity also increased, the price of raw material also increased. That led to increase in the steel price. So this is known as your cost push. This is not from the demand side, this is from the supply side. That means increase in the input cost, like electricity is used by those industries to produce steel, so the price of electricity increased. So that means the price of input or price of cost is increasing with this particular industry. That's why the final product's price will also increase in the economy. So that's why I have given this example, raw material and electricity. So this is the difference between the two, demand pull and cost push. Okay. So, so whenever RBI tries to control the money supply, I repeat, whenever RBI tries to control the money supply or to control the inflation in the economy, because RBI has that role to control inflation in the economy, RBI targets this part of the economy or demand pull side, or you can say demand side. How? RBI tries to control the money supply in the economy. If money supply will come down, then definitely purchasing power of the people will come down. Clear? So RBI tries to this part of the inflationary condition. So whenever you see that inflation is in economy or inflation is prevailing in the economy, then you have to keenly observe whether this inflation is due to demand pull or cost push. If it is demand pull, then RBI may be able to control the inflation if it is due to the demand pull. But if inflationary situation is due to the cost push, then RBI may not able, or the monetary policy of the RBI may not be effective to control the inflationary situation. Then the government must act to rectify these prices so that the price of the commodities will come down. Okay, so when this inflation is from the demand side, then yes, RBI can easily control that inflation. But if inflation is the supply side or due to the increase in the cost push, then it's difficult for the RBI to rectify that inflation. Government must interfere to control or regulate that inflation. So this is the difference between the two, I mean demand pull and cost push. Clear? Now, moving to the next measurement of inflation. Measurement of inflation. That means how inflation in our country is measured. In India, CPI combined. What is the meaning of it? Consumer Price Index. Consumer Price Index combined is declared as the new standard for measuring inflation. So whenever RBI wants to measure what is the rate of or what is the prevailing inflation in our country, then it is CPI combined. You can measure through this CPI combined. This is one such index through which inflation can be measured, and it is measured on the monthly basis. It is measured on the monthly basis. Okay. Now, so CPI is one such index which studies the change in prices. CPI studies the change in prices of goods and services. That's why we use this as an indicator for measuring inflation. Now, CPI is also used. CPI is also used to determine or to revise the wage rate or allowances to the employees. So these are some of the use of CPI. So whenever you revise the allowances given to the employees of government, then you have to consider the index CPI so that you would know what is the index or what is the inflation, so that we can revise those wage rate so that employees can sustain or can afford those increased price of goods and services. So this indices First, I told you CPI combined is used for the measurement of inflation in the economy. It is measured on the monthly basis. It reads or studies the change in the price level of goods and services. Again, I also told you that CPI is used for the wage and allowances to the employees. So whenever government goes for the revision of this dearness allowances, then government considers this CPI index. And finally, CPI is used by RBI for inflation targeting. Or inflation targeting means to control inflation in the economy, because the CPI is used to measure the inflation. Okay. Now, this CPI or consumer price index is compiled or published by the price statistics division. This kind of question you can expect, like who is the authority publishes this index. So you can expect such question. Earlier also UPSC has already asked, so you can expect such question. They can ask, so who is the authority who publishes or produce this particular index? So it is Price Statistics Division of the National Statistical Office. And the ministry which deals with this particular index, that is Ministry of Statistics and Program Implementation. Price Statistics Division, National Statistical Office, MOSPI, Ministry of Statistics and Program Implementation. This particular ministry compiles this data of CPI, and this CPI, there are various measures under the CPI, but this particular organization compiles CPI rural, CPI urban and CPI combined. CPI rural, CPI urban and CPI combined, and the base year for this CPI is 2010. Base year for this CPI rural, urban and combined is 2010. Now, you may ask, sir, what is this base year? Base year is something, a statistical term which is used for the measurement of indexes. Like WPI also will discuss. Any other index, you have to use a base year. Base year is generally considered what? It is generally considered, when those policymakers, they consider a normal year as the base year for this comparison. Let's say if you want to measure the inflation of or price level of 2020, which will be the current year, then you have to see how much price has been changed from 2015 to 2020. Then 2015 would be your base year. You want to compare the current price level with the previous one. So the previous one would be your base year. Okay. So you have to, in case of comparison, we try to find out the base year and the price level at the current year. Okay. Now, so this particular division which publishes this data, rural, urban and combined, base year is 2010, and recently this has been revised to 2012. Earlier it was 2010 and now it has been revised to 2012. Okay. Along with this, there are other CPI indices as well. Along with these three, rural, urban and combined, there are other CPI indices to measure the inflation. The first one is CPI IW, industrial worker, CPI agricultural labor, CPI industrial worker, CPI agricultural labor, and CPI rural labor. Okay. These three, industrial worker, agricultural labor, and rural labor, these three are compiled by Labor Bureau. You have to remember these because they ask in your prelims. Labor Bureau, and this Labor Bureau comes under this Ministry of Labor and Employment. Ministry of Labor and Employment. Another index, CPI, these are factual in nature, so try to remember these. CPI urban non-manual employees. Another index, CPI urban non-manual employees. And again, this Ministry of Statistics and Program Implementation compiles this data of CPI urban non-manual employees. So simply you can maintain this thing. I mean, you simply can put all these into a box like index and publishing agency. So you can write in this way: CPI IW, CPI AL, RL, and then UNME. Then again this your rural, urban combined. So here all these three, Labor Bureau, and this is your Ministry of Statistics and Program Implementation, and these three also the same, Ministry of Statistics and Program Implementation. So whenever you read, so that it will be easier to remember, you can maintain these whole facts into a single table. Okay. If CPI is clear, then we are moving to the WPI. Wholesale price index. Consumer price index we discussed, then wholesale price index. It is published by Office of Economic Advisor. Office of Economic Advisor, that comes under the Ministry of Commerce and Industry. Ministry of Commerce and Industry. They sometimes ask who is the nodal agency, who is the publishing agency. So please remember this: Ministry of Commerce and Industry, Office of Economic Advisor. The base year is 2011-12, which was revised in 2017. The base year is now 2011 and 12. So this, what this exactly measures? It measures the price at wholesale level. Wholesale price. This does not deal with retail price like CPI. CPI deals with the retail price or consumer price, but this deals with the wholesale price. Okay. Under this index, the whole basket of goods has been divided into three categories. Let's see that. First category is primary articles. First category is primary articles with the weightage of 22.62%. This is the first category. Second category, fuel and power. Second category, fuel and power, and the weightage that has been given to this is 13.15%. The weightage. Third category, manufactured products. Manufactured products. That comes under, or the weightage given to this category is 64.23%. So this could be a question for you in prelims, like they can give you these three options and they can ask you which of the following has given the more weightage under the wholesale price index. So you have to remember the primary articles 22.62, the fuel and power 13, and manufactured, that means 64. So highest weightage given to the manufacturing products 64.23%, and this is the second weightage given to primary articles, and the third, which is fuel and power, 13.15% weightage. So why I am giving emphasis to this particular question or this particular topic, because they have already asked CPI versus WPI. We are also going to discuss that. So since they have already asked this, you can expect question on this: which of the following has the more weightage in the wholesale price index? So it is the manufactured products, right? So you have to remember that. And who is the agency which compiles it? It's Office of Economic Advisor, Ministry of Commerce and Industry, and specifically the Department for Promotion of Industries and Internal Trade. This industry compiles this data. So coming to this part, like what is the difference between CPI and WPI? This they have already asked. Let's see that as well. I have already told you CPI or consumer price index tracks inflation at the consumer level, but this WPI at wholesale level. This is the first difference between the two. It is, you can say it measures the retail price level and it measures the wholesale price level. And the second is WPI does not capture the change in services. It does not capture the change in services. It only captures change in price of goods only. It does not consider the change in price of services. But CPI measures both goods and services, or change in price of goods and services. CPI does that, but WPI does not. So this is the second difference between these two. Coming to the third, already I have told you that in WPI more weightage to given to your manufacturing products. But in the CPI more weightage to given to this food items. This is another difference. Food items. Okay. In WPI, manufactured products were given more weightage, and in CPI, it is the food items which is given the more weightage. Okay. The next segment of our discussion is, whenever you have seen inflation in the newspaper, you must have seen one concept, that is base effect. And this base effect base effect. This base effect was already asked by UPSC in 2011. So let's discuss what is this base effect. I am giving you one example. Through that you please try to understand that. Suppose you want to compare, let's say, 2021 inflation with the 2019. What actually happens? Suppose you saw that 2021 the inflation is or price level is 7%, and you saw that just in the same corresponding time period or in same quarter in 2019 the inflation was 3%. I repeat, in 2021 the inflation was 7%, and in the same quarter in 2019 the inflation was 3%. So now the difference is 4%. Then you will see there is a increase in the rate of price level, or there is an inflationary situation in the economy. You can reframe this particular statement. You can say this inflation is high due to the base effect, because this base effect is at a lower side, or this year's inflation is at a lower side. That's why this the 7% increase in the price level, or 7% price level, shows a higher increase in the price level. I repeat, suppose, I mean, simply what happens in practical measurement, or when they measure, or this base effect has been shown to the policy makers, what they do, they generally suppose they want to calculate the price level of the first quarter of 2021, and they will compare it with the same quarter but for the year 2020. And suppose they found that the price level during this year or at the same quarter it was 2%. So they will say, since it was at a lower side, so increase in the price level in 2020 seems to be higher. If it would be like, let's say, 5%, then you can say there is less amount of base effect, since already it was at a higher side. So base effect is not that much, or inflation has not increased that much. So when they compare, they also compare with respect to this, whether previous year inflation or price level at a higher side or lower side. That is what they say base effect. They can say this year the higher price level is not due to increase in the price, but due to the base effect, because the same quarter in the last year the price level was at a lower side. That's why the difference seems to be a higher one, right? So that is the base year. So if you want to define the base year, then it is inflation in the corresponding period of the previous year. Inflation in the corresponding period of the previous year, that is known as your base effect. Clear? If you still do not understand, please let me know. I will definitely explain to you. So moving to the next segment, and the next segment, let's discuss two important concepts: headline inflation and core inflation. Headline inflation and core inflation. Headline inflation means simply it consider all goods and services. I repeat, headline inflation means it considers all goods and services. When you speak about the core inflation, then it excludes food and fuel. It excludes food and fuel, but headline inflation, it consider all goods and services. correct? So this is the difference between the two. Then why in the core inflation we do not include this food and fuel? Because these price level are more volatile in nature. More volatile in nature. That's why with one inflation we measure inflation by including these volatile products. In one indicator we exclude these volatile products and try to find out the inflationary situation in the economy. So that's why core inflation is less volatile and headline inflation is more volatile in nature. Clear? Because core does not include fuel and food items. Clear? Now, moving to the next segment, inflation targeting. Till now, any doubt you have? Pallas is asking, sir, what comes under this primary articles? Primary articles simply all about your consumer goods. Okay, that comes under the primary articles. Base effect. Okay, we'll go a bit slower. Base effect, I told you, suppose this 2021 first quarter and 2022 first quarter. Okay, these 2 years of inflation. So current year is 2022 and in the first quarter of 2022 you found 7% as the price level, correct? So you saw that in 2021 first quarter the price level is 3%. The difference is what? 4%. So you may say, 7% in the current year. So you will say that inflation is at 7% or at a higher side. Then policymakers, they say it seems to be higher because the previous year inflation of the same corresponding period, inflation was low because it was 3%. So it seems to be higher because of the base effect or low base effect. Lower was the inflation, that's why this base effect shows a higher increase in the price level. If it would be 5%, then the difference is only 2%. Then you would say that due to the base effect only, the inflation is at a lower side. Clear? Simply you can say 5% से 7% rise हुआ है, तो inflation क्या हो? Inflation is not that much. But जब 3% से 7% को जा रहा है, then they will definitely say inflation is at a higher side. So policy maker क्या बोलते हैं? ये इसलिए ज़्यादा दिख रहा है because the inflation rate was lower in 2021 on the same period or the same corresponding period. Okay, and if 5% was the inflation rate, then policy makers बोलेंगे already वो high था, ठीक है, इसलिए inflation ज़्यादा नहीं है, क्योंकि 5 से 7 आ रहा है, यहाँ 3 से 7 आ रहा है. So that difference is the base effect. So here, due to the high base effect, it says higher increase in the inflation. Clear? Primary articles, I have already told you, the goods and services, those consumer goods and all. Okay. Yes, headline inflation is more volatile because that includes the fuel and the food. These are volatile products. That's why their price varies a lot. Does base effect include increase rate of price in both goods and services? No, simply see here they do not include, or in the base effect, they do not consider the price of goods and services and all. Simply they compare this price level only. The rate of inflation in the 2021 the first quarter, the rate of inflation in 2022 this the first quarter. This simply they compare between the 2 year. Okay. Now coming to this inflation targeting. What is this inflation targeting? This inflation targeting means they want to, or simply when inflation is prevailing in our economy, then you have to control that. What is why you need to control? Because it affects different sections of the society differently. Suppose it affects the most to the what fixed income group. Fixed income group means those income are not increased with the increase in the price level in the economy, like increase in the dearness allowances kind of thing. Okay, what government does with the increase in price level, government also revises those DA of those employees. But those who are coming under this fixed category or fixed income group, they suffer the most. Okay, suppose those daily wage workers, their wages are not revised every year, so they are also suffering due to this inflation as well. So that curtail the purchasing power of the people. Okay, with that curtail purchasing power of the people, it will definitely reduces the demand or consumption of the people. When the demand will come down, then that will lead to, I mean, the production of the economy will also come down. How? Suppose demand will come down, then supply will increase because you have already increased the capacity of your economy. So supply is there, but demand came down. So you will have more unsold products in the economy. So when already unsold products in the economy are there, so definitely those industries will reduce their production. Gradually, this will turn into a what? At a downward movement of the economy, unemployment will rise, and your job losses will be there. So everything will go into a downward movement. As you have seen during the pandemic time as well, when unemployment increased and migrants, they were coming back to their home, job losses were there, so economy was at a downward movement. So that's why we try to control the inflationary situation in the economy. Now, so what is this inflation targeting? The concept inflation targeting means that a range of, or you can say a range of target of inflation was announced, or you can say we decided a range of inflation rate at the official level for our country. What is that? It is done by the central bank. It done by the central bank to have a stable price level in the economy. If you fix a range, let's say you have fixed that inflation must be around, let's say 4 to 8%, let's say. This is the range. Why you are fixing that particular range? Because you will not give to vary these price level beyond this 8% or below this 4%. So you fixed it that it is the sustainable inflation rate through which economy can sustain in a smooth manner, or it will stable the price rise. Okay, that's why you have fixed this range of inflationary target, which we call this inflation targeting. In India, at the official level, or we can say formally, in 2015, this inflation targeting was adopted. I repeat, in India, formally or officially, in 2015, this inflation targeting was launched or adopted. It was an agreement between the two parties. One is RBI, another one is the government. Two parties, one is RBI, another was the government. And they signed one agreement, and the name of the agreement was Agreement on Monetary Policy Framework. Agreement on the Monetary Policy Framework. So in that framework, or in that agreement, both these parties decided or they finally agreed upon, let's decide a range of inflation rate so that it would be, you can say, through that inflation or price level, a sustainable growth can be achieved for the economy, which is not will not affect those people very badly, so that we can manage with the economy, so economy can sustain for a longer period of time. That was the idea behind this inflation targeting, which was brought in India at official level in 2015 between this RBI and Government of India. What exactly the reason behind it? Because in 2015 and before this 2015, there was so much of controversy between the RBI and Government of India. Government of India was wanted to influence the policy measures of RBI through this. Influencing the autonomy and everything, some favorable monetary policy which affects the government's interest. So that was the time when all the controversies was going on between the RBI and the government, and finally they agreed upon this particular inflation targeting, and finally in 2015 they came with this particular concept. Let's see what are the highlights of this inflation targeting, or technically this agreement. What are those targets? Let's see. They decided the target or the inflation, the target of inflation shall be 4% with a range of plus and minus 2. I repeat, they finalized or they fixed the target of inflation shall be of 4% with a plus minus 2. That is, it could be 6% with the plus 2, it could be 2% with minus 2. So this is the range 2 to 6. This is the range of inflation 2 to 6%. This is the first highlights, or you can say first feature of inflation targeting. The second one is every 6 months RBI would fix or publish a document. RBI would publish documents like source of inflation, that means reason behind the inflation, first. Second, forecast the inflation for the period of 6 to 18 months. Forecasting the inflation for the period of 6 to 18 months. Okay. And the third one is, if RBI fails to control this inflation target within the range of 2 to 6%, then RBI would definitely give explanation why this particular RBI has failed to control the inflation or the target of inflation. And that would happen if beyond this 6% inflation would continue for next 3 quarters or consecutively 3 quarters. 6% से ज़्यादा if inflation continues for more than 3 quarters consecutively, then that means RBI has failed to control the inflation in the economy. So these are some of the features. First one, 2 to 6% was the range. Then RBI would publish documents like sources of inflation, then forecasting of inflation from 6 months to 18 months. And then if RBI fails to control, then RBI would give explanation why this particular agency has failed to control the inflation and what should be the range where you can say that RBI has failed to control the inflation. It is beyond 6% for the next 3 consecutive quarter. Okay. Now, along with this inflation targeting, there was a major change with respect to this inflation targeting. This was Monetary Policy Committee. This was formed between the government and the RBI to control the inflationary situation in the economy. So this Monetary Policy Committee was formed by the amendment of RBI Act 1934. So this was formed by the amendment of RBI Act 1934. So let's see what are the composition of RBI. Sorry, composition of this Monetary Policy Committee. Composition of Monetary Policy Committee. This Monetary Policy Committee has 6 members. This Monetary Policy Committee has 6 members. Sometimes I think it was asked in 2017 who is the ex officio chairperson of this Monetary Policy Committee, but they can ask like question, who are the members, about the members, you can say about the composition they can ask, about the members, their appointment they can ask. So let's discuss that. 6 members committee. Out of these 6 members, 3 members would be the government nominated members. The government will nominate those 3 members out of this 6. And just mind it, there is no government officials will be there in this 6 members committee, or you can simply say no government official. These three persons will be nominated by the government, but must not be the government officials. This is the first. Other 3 from RBI only, and the governor of RBI would be the ex officio chairperson. The governor of RBI would be the ex officio chairperson. And what are, who are those 2 other officers or 2 other members? Out of these 3, one is the governor and the second one is the deputy governor, who is in charge of this monetary policy. Deputy governor who is in charge of this monetary policy in the RBI or Reserve Bank of India. This is the second member. And the third, one of the executive director of RBI. And the third, one of the executive director of the RBI. These 3, those who are nominated by the government, a selection appointment committee will be there. Under the cabinet secretary would be the member, RBI governor and the secretary of Department of Economic Affairs. 3 members appointment come selection committee would determine these 3 members, or will nominate these 3 members. One is cabinet secretary, RBI governor, and the secretary of Department of Economic Affairs. Okay. So what are the qualifications of these 3 nominated members? There is no such exclusive qualifications are given, but it has been said that they must be, they are experts in the field of economics, banking and finance. They must be expert in the field of economy or economic, banking and finance. They would be nominated by these 3 member committee. And these members of MPC or Monetary Policy Committee would be these members would be appointed for 4 years. These 3 members would be appointed for 4 years with shall not be eligible for reappointment. They cannot be reappointed. Only the tenure of those nominated persons are 4 years. The decision making or the decision taken by majority vote in this monetary policy committee. The decision is taken on the majority vote, each member having a 1 vote or single vote. So what is the role of governor? When we say that governor is the ex officio chairperson, then what is the role of governor? Governor has a role of what? Casting vote. Casting vote in case of tie. So to break the tie, governor has that casting vote. Clear? Governor does not have a veto, but it has a casting vote. In case of tie, suppose 3 and 3, the votes are equal, then governor has the power to again vote to break the tie, and finally decisions are taken. Okay. So these are all about your MPC, Monetary Policy Committee, and its composition, different members, and decisions are taken on the basis of majority, and RBI governor has the casting vote. Okay. So now also when this your to control the inflation, this monetary policy committee, they come together and finally take the decision what should be the next course of action to control the inflation in the economy. Generally, I mean 6 times or 7 times in a year they sit together to take any such decision on the matter of monetary policy of RBI. Okay. So we are moving to the next segment, that there are different tools through which RBI controls money supply. Different tools through which RBI controls money supply, and we have divided into 2 types. One is your quantitative and qualitative. Quantitative and qualitative. What are those quantitative tools? What are those quantitative tools? Can you please answer? Quantitative tools are like your CRR, SLR, bank rate, repo, reverse repo. So these are quantitative tools or techniques through which RBI controls money supply in the economy. Now you may ask that, sir, why this name is quantitative tools? The name is quantitative tools means it simply quantify the amount of which money supply must be taken place in the economy. It is simply, you can say that these are I mean these tools or these measures are expressed in terms of what? Percentage. So it helps to quantify the amount of money supply in the economy. For example, suppose let's say CRR is the 4% prevailing in our present in current situation. CRR is at 4%. That means you are quantifying this tool of money supply, or this controlling tool of money supply. So that's why this is known as your quantitative monetary policy or quantitative tools. Qualitative means RBI is controlling. We have already discussed quantitative and qualitative. Qualitative means RBI is directing the nature of extending loans or lending activities. I mean, what should be the nature of this lending activities or these loans? In which sector RBI must give, commercial banks must give more loan, and which sector are commercial banks will give lesser loan, that comes under this qualitative one. So this is the difference between quantitative and qualitative. And first such instrument under this quantitative, I have already introduced before you, that is CRR, cash reserve ratio. The full form of CRR is cash reserve ratio. Banks or commercial banks must keep deposits with RBI. I repeat, commercial bank must keep some amount of deposits with the RBI. That is known as your CRR or cash reserve ratio. Against these deposits, RBI does not pay any rate of interest. RBI does not pay any rate of interest under this cash reserve ratio. Then you may ask, sir, what is the law which authorizes this CRR, that every commercial bank has to maintain this CRR? It is RBI Act 1934 authorizes that every commercial bank will fix or keep some deposits with the Reserve Bank of India. Next, then who decides or who determines this CRR? Obviously, Reserve Bank of India decides this CRR or fix any amount for this CRR. Present CRR, I guess 4%. Okay. All the commercial banks or you can say or scheduled commercial banks maintain a same CRR, but RBI can prescribe a separate CRR for regional rural banks and cooperative banks. I repeat, RBI may prescribe a separate rate under this CRR for regional rural banks or commercial banks. Then how this CRR affects the money supply? When CRR increases, then money supply goes down in the economy. I repeat, when CRR increases in the economy, money supply goes down in the economy. You may ask, sir, how? When CRR increases, then banks or commercial banks has to keep more funds with the Reserve Bank of India, then they will have less fund for the lending activities. So when they have the less fund for the lending activities, they will increase the cost of borrowing, or the rate of interest of borrowing will increase. When the cost of borrowing will increase, it will affect money supply, because people will take lesser loan or lesser borrowing from the commercial banks, since it is charging a higher rate of interest. So that is how this CRR affects the money supply in the economy. Clear? So just remember, it does not pay, or RBI does not pay any kind of rate of interest when commercial banks keep this deposit with the RBI. So you can say the objective of CRR is to control money supply or to regulate commercial banks from over lending activities. Over lending activities. This is the objective of CRR or cash reserve ratio. Okay. Now, moving to the next concept, SLR. What is this SLR? Statutory liquidity ratio. Statutory liquidity ratio. In case of CRR, we have discussed CRR is maintained by commercial banks with the Reserve Bank of India, but in case of SLR, these deposits are kept with the banks itself. So bank will keep those deposits with themselves, whereas the CRR is kept with the RBI. So if bank keep these SLR with themselves, in what form? In what form? It is kept under the form of cash, gold, and also treasury bills. Cash, gold, and treasury bills. I think this two you know, but what is treasury bill? Treasury bill is something that, suppose I am giving you one example. One person purchased some product. Suppose person A purchased some product from B, and A could not pay during that time, or could not pay at the time of its purchase. So what they did, they sign an agreement between the two parties that the person A will pay this much of amount after this period of time at this particular price or this particular rate. Okay, so that at the time of maturity, this person has to repay that amount back to person B. So it is used kind of, you say, deferred payment. If you are not able to pay now, then you can pay it future if you carry this treasury bill. Or simply the person B can carry this treasury bill and approach the bank where this particular person A has an account, and that bank will pay straight to the person B with the exchange of this treasury bill. So commercial banks also keep cash under this SLR, gold under this SLR, as well as this treasury bills. Now, coming to the next part, in case of CRR, we have seen that as per the 1934 Act, this has been mandated that every scheduled commercial bank will maintain the CRR. But in case of SLR, it is Banking Regulation Act 1949 mandated that every commercial bank will give such amount as SLR. Clear? CRR as per the 1934, SLR as per the 1949. Clear? Second feature, you can say, legally SLR cannot be more than 40%. Repeat, SLR cannot be more than 40%. So it must be less than the 40%. How we'll discuss the banking reforms after 1991, that we entered into the phase of liberalization, privatization, globalization. But during that, before this 1991 phase, the SLR, the amount of SLR in fact was larger than this 40%. Later on, it was amended and as per the recommendations of many committees, it was finalized that it cannot be increased beyond 40% as per the Banking Regulation Act 1949, and it has been mandated as per the 1949 that commercial banks has to maintain this SLR. Coming to this second aspect of it, like CRR, all the scheduled commercial banks has to maintain this SLR, and like RRBs and urban or cooperative banks, for which RBI can prescribe a special range or special slab, the same manner in case of SLR as well. For RRB and cooperative banks, RBI can prescribe a separate slab of SLR. Okay. Now, question is how this SLR affects the money supply in the economy. When SLR increases in the economy, money supply would come down. Now, how? The same thing we have already discussed in CRR and relation with the money supply. So, increase in the SLR, then bank will keep more cash, more gold and more treasury bills with itself, so that it cannot involve in the lending activities, because this SLR cannot be used for the lending activities, or this, even if it is deposited with the bank itself, but you cannot use that amount in case of lending activities. That's why lesser amount is available with the banks for the lending activities, and rest is the, already we have discussed, lesser will be the fund, that they will increase the rate of interest, so it increases the borrowing cost, lesser money is available with the economy, so that will lead to reduction in the money supply in the economy. CRR and SLR both are counted fortnightly basis. Both are counted fortnightly basis. If RBI finds that a particular scheduled bank does not follow this CRR SLR, then that bank has to pay the penalty. Then that bank has to pay the penalty to the RBI. And this penalty rate is attached with the bank rate, or linked with the bank rate, because bank rate is something is also known as what? Penal rate. We'll discuss what is this bank rate. Okay. So, if RBI finds that a particular scheduled commercial bank does not follow this guidelines of SLR and CRR, then RBI imposes penalty on this commercial bank, and commercial bank has to pay that penalty, which is linked to the bank rate. Now, next discussion is what is this bank rate? What is this bank rate? Bank rate, simple, you can say the rate at which commercial bank borrows money from the RBI or borrows money from RBI for a long term. I repeat, you can simply say the rate of interest at which RBI gives or lends money or commercial bank borrow money from RBI at a rate that is known as your bank rate. That means RBI gives loan to the commercial bank at the rate of bank rate for a long period of time, or you can say a long term loan. Now question is, what exactly RBI keeps with itself against this loan, or what is the collateral, or you can say what is the security against it? There is no such security or collateral is given against this bank rate or against this long term loan. Okay, so without any kind of securities and collateral, RBI gives loan to the commercial bank at a rate which is known as your bank rate. Clear? Now, bank rate is used for the computation of penal rate. That means if RBI wants to collect some penalty price from a particular bank, then RBI collects money from that bank under this particular rate. Okay. In the next segment, I am going to introduce a concept before you, that a bank rate equals to marginal standing facility. Bank rate equal to marginal standing facility. What is that? Or what is this marginal standing facility? This marginal standing facility was introduced in 2011. This marginal standing facility was introduced, this concept was introduced in 2011. Then what is this concept? The interest rate at which RBI provides loan or short term funds to the commercial bank with this government securities as collateral. I repeat, RBI, or the rate of interest at which RBI gives fund to commercial banks or a short term funds to the commercial bank against the government securities as the collaterals. When this marginal standing facility is used by the commercial bank, marginal standing facility is used by the commercial bank to borrow short term funds when the bank is running out of funds or running in the shortage of funds. Then commercial banks borrow money from the RBI at this MSF, which is equal to bank rate, against this government securities. Okay, and it has been notified, or you can say it is definitely coming to your mind, like how much percent or what is the quantity that commercial bank can borrow money under this MSF or this short term funds. You can say, or the answer is, commercial banks can borrow money or these short term funds only up to 1% of their net and time liabilities, or you can say net and time deposits. So up to 1% of their deposits, money they can simply borrow. Suppose this NT net and time liabilities or deposits is 1,000 rupees of a particular scheduled commercial bank. So only up to 1% of that amount of deposit can be borrowed by scheduled commercial bank from the RBI under this marginal standing facility rate. Okay. Clear? This is all about your bank rate and marginal standing facility rate. If you have any doubt, please let me know. First, let's clear those doubts and then move to the next segment. If you have any doubt, please let me know. Jyoti is asking why this different classification of inflation. Classification of inflation is only, let's say, the CPI agricultural labor. So when government revises the wage rate at the rural level, then government consider this CPI AL. Suppose government wants to revise the industrial worker or minimum wage rate of the industrial workers, then government will use that index to revise the wage rate of industrial workers. So for different use only this indices are used, or different indexes are used. Okay. Jyoti, don't confuse with this base effect and base year. These two are different. Base year means generally we fix a year through which we can compare this particular index. Suppose every index has its own base year. Like CPI, I have told you, they revised the base year to 2012 and before that it was 2010. So base year is something different from the base effect. Base effect means, simply I have already told you, just corresponding period of the previous year. Suppose if you want to know the inflation of 2021 of the first quarter, then you have to see the inflation of 2020 of that same first quarter, then you can compare between the two. So base effect is something, base year is something. Okay, so both are different, so don't confuse with these two. PK, no, we PK is asking, we always take previous year as the base year. No, base year could be anything which is generally considered as a normal year. That means it's free from abnormalities. Base effect is something different from base year. I repeat, base year is something different from base effect. Base year we generally consider a previous year, but not exactly the just previous one. I mean, let's say you want for a let's say for the calculation of GDP, you can take 2015 as the base year. Okay, for the CPI there and WPI 2012 as the base year. So it's not necessary that the previous year is considered as the base year, but in case of base effect, To know the base effect, they consider the previous years, the same or corresponding period. Okay. PK, I think your doubt is clear. But yes, that's true. Base year is changed according to the socio-economic effects. I mean, it depends on the year, or it generally different aspects of economic scenario are considered while considering a year as the base year. Okay. Base year, yes, base year remains the same till the time government revise it again. So, till, I mean, from the last 5 years, this base year of CPI is still, or base year of WPI is still 2012. Okay. Okay. Pinky is asking, sir, but there left 5 members, how tie would happen? Generally, suppose all the members, including the governor, they give their vote, and finally a tie is there. I mean, governor also at the first instance supported this RBI members, and then RBI, the personals of RBI like deputy governor, and executive director, they gave 3 votes to a policy, and other 3 also against this 3. So tie is now 3:3. Okay. Now governor has the casting vote, whether governor can support this, I mean, RBI personal's opinion, or the government officials, or the nominated members of government opinion. So it depends on the governor's voting. Chayan is qualitative, is not OMO. OMO comes under this quantitative controlling measures. So qualitative is something different. PK, I guess I have already explained this. 5 members are there, yes, 3 plus 2, and the 6th one is governor. First instance, governor does give his vote. After that, governor gives the vote of, I mean, this casting vote to break the tie. PK is asking, does cash reserve ratio changes as per change in the cash with commercial bank? It's not like that. It is decided by the RBI only what should be the rate of cash reserve ratio. Then it is kept by commercial bank with the RBI. So it decided, it does not depend on the availability of cash with the commercial bank. It is up to the RBI to decide what is the rate of CRR. Cash reserve ratio is always in terms of cash only. Yes, percentage of the deposits they keep with the RBI. Yes. Actually, let me tell you this about the CRR. Generally, what happens? CRR consists of 2 things. I mean, I think I have already explained with you this cash and with maybe some financial assets. Sometimes they can keep it cash, or sometimes they can keep with the bonds and other financial assets. Okay, that is the reserve fund, you can say. Pinky, yes, RBI governor gives his vote 2 times at the first instance, and second when the uh, tie is there and casting vote, he has that power. Okay. Current bank rate, I do not know about the present current bank rate. If you, if possible, then Google it out. Ankur is asking difference between penal rate and bank rate. See, bank rate is generally considered as the penal rate because it is used for the penalty. Okay. Reverse repo rate, we yet have not discussed that. Repo rate and reverse repo rate we'll discuss now. So let's discuss reverse repo rate and reverse repo rate. Okay. So first is repo rate. What is repo rate? Can anybody answer? What is repo rate? Can anybody answer what is repo rate? The rate of interest or the interest rate. The interest rate at which RBI lends short-term loans. RBI lends short-term loans. RBI lends short-term loans as government securities as the collateral. Government securities as the collateral. That is, interest rate at which RBI lends short-term loans, government securities as the collateral. That is your repo rate. Why this repo rate is there? Repo rate means simply when the RBI lends this against this government securities, then those clients, or you can say the commercial bank, enters into an agreement. Agreement of what? Agreement of to repurchase this government securities. Okay, repurchase this government security at a predetermined price. Predetermined price that is known as your repo rate. This repo rate helps in controlling inflation in the economy. That means RBI lends money. What does it mean? That means commercial banks are taking loans from the RBI on this particular rate of interest. So if rate of interest will increase, definitely money supply will come down in the economy. Okay, this is one. Second is your reverse repo. What is this reverse repo? Reverse repo says that interest rate at which RBI takes loan, simply. That means those commercial banks, they park their fund with the RBI at this rate of interest. Okay. So again, the government securities are used as the collateral. Here also, it has been guaranteed for the what? Resale by the RBI. That's why it is also known as your reverse repo rate. So simply you can remember, in case of repo rate, commercial banks takes loan from the RBI. In case of reverse repo rate, RBI takes loan from the commercial bank at this rate of interest. Clear? And in both the cases, government securities are used against as a collateral against these loans. And both these are short term in nature. Both these are short term in nature. Okay. One question you must, or one question that you must come to your mind, whether this government securities that is used to borrow money by the commercial banks, whether those government securities are coming from the SLR quota or not. SLR quota or not. Sometimes when a crisis like situation arises in front of the bank, they can borrow money from the Reserve Bank of India by using this government securities from their SLR quota. From their SLR quota or statutory liquidity ratio quota. Since banks use their SLR quota, definitely they have to pay a penal rate for this. Clear? So that is how this repo and reverse repo operates in the economy, or how these are this mechanism are going on. Jyoti is asking, only CPI combined used for calculation of inflation only, not WPI. When RBI measures the inflation and RBI takes this inflation targeting to control this inflation, then it uses this CPI only. Okay. I think these are different tools that we have discussed. So if you have any doubt, please let me know. Otherwise, actually, we have to end this class here only. We'll meet again on Monday with some new topics. We will continue the banking and all, the whole banking in our country. The Reserve Bank of India we have already discussed. We'll discuss the commercial banks. Then we'll discuss the urban cooperative banks and other banks as well, because banking is a section which is favorite of UPSC. We'll discuss that. So we are ending this class a little bit early due to some problem. So we'll discuss those concepts and other banking concepts in the next class, that is on Monday. Okay. Akash will discuss that LPRO and all on the next class. So if you have any doubt, please let me know. I will definitely answer you back. Thank you very much.